The third learning objective is to measure interest expense on bonds using the straight line amortization method. The journal entry to record issuing a bond payable at maturity value includes a debit to cash and a credit to bonds payable. In this example, maturity value is $100,000 and the interest rate is 9%. These bonds pay interest semi-annually, as do most bonds. Every 6 months, the company pays interest of $4,000 to the bondholders. This is computed by the interest formula. $100,000 times 9% times 6 divided by 12. Interest expense is debited and cash is credited. When bonds mature, bonds payable is debited, which will zero out the account, and cash is credited to record the payment to the bondholders. Journalize the following transactions for Vernon and include an explanation for each entry. The Vernon Corporation issued $110,000, 6.5%, 15-year bonds payable. The issuance of the bond at par on January 1st, 2012. Cash, $110,000, and bonds payable, $110,000. Vernon Corporation journalize the following transactions for Vernon and include an explanation for each entry. Payment of semi-annual cash interest on July 1st, 2012. Interest expense, $3,575. Debit and cash credit of $3,575. The payment of the bond at maturity. That's January 1st, 2027. Bonds payable, debit, $110,000, and cash credit, $110,000. Market conditions may force a company to accept a discount price for its bonds. Suppose a company issues $100,000 bond of its 9% 5-year bonds that pay interest semi-annually when the market interest rate is 10%. The market price of the bonds drops to 96.149, which means 96.149% of par value. The company receives $96,149 at issuance and makes this journal entry. Debit cash for the amount received and credit bonds payable for the maturity value of the bond. The difference of $38.51 is the discount and has its own account. Discount on bonds payable is a contra account to bonds payable. Bonds payable minus the discount given the carrying amount of the bonds, known as carrying value. The balance sheet presents the carrying value of the bonds. It displays the maturity value of the bonds, less any bond discount, to arrive at the carrying value. What happens to the $3,851 discount? The discount is additional interest expense to Smart Touch. This discount raises the company's true interest expense on the bonds to the market interest rate of 10%. The discount becomes interest expense for the company through the process called amortization, the gradual reduction of an item over time. Amortize a bond discount by dividing it into equal amounts for each interest period. This method is called straight line amortization, and it works very much like the straight line depreciation method. Therefore, 1 over 5 years, 1 year out of the 5-year life, becomes 6/12 of the year, semi-annually, or 1/10 of 3,851 bond discount, which is $385 rounded. This amortized each interest period. The cash payment equals the regular stated interest payment. Interest expense of $4,885 for each 6-month period is the sum of the stated interest, $4,500, which is paid in cash, plus the amortization of the discount, $385. This same entry would be made again on December 31st, 2013. So the discount balance would be $3,851 minus $385 from June 30th entry, and $385 from the December 31st entry. This equals $3,081 balance on the discount on bonds payable account on December 31st, 2013. Discount on bonds payable has a debit balance. Therefore, we credit the discount on bonds payable account to amortize or to reduce its balance. 10 amortization entries will decrease the discount to 0 with rounding. Then the carrying amount of the bonds payable will be $100,000 at maturity. Origin Inc. issued a $40,000 5% 10-year bond payable at the price of $90 on January 1st, 2012. Journalize the interest of the bonds payable on January 1st, 2012. We will receive cash of $36,000, the discount on bond payable of $4,000, and bond payable credit of $4,000. Journalize the payment of semi-annual interest and amortization of the bond discount or premium on July 1st, 2012, using the straight line method to amortize the bond discount or premium. Interest expense $1,200, discount on bonds payable $200, and cash credit of $1,000. To illustrate a bond premium, assume that the market's interest rate is 8% when the company issues its 9% 5-year bonds. These 9% bonds are attractive in an 8% market, and investors will pay a premium to acquire them. The bonds payable account and the premium on bonds payable account each carries a credit balance. The premium is an adjunct account to bonds payable. Adjunct accounts are related accounts that have the same normal balance and that are reported together on the balance sheet. The balance sheet presents the carrying value of the bonds. It displays the maturity value of the bonds plus any bond premium to arrive at the carrying value. The 1% difference between the bonds' 9% stated interest rate and the 8% market rate creates the $4,100 premium. That's $4,100 minus $100,000, which is the face value. The company borrows $104,100, but must pay back only $100,000 at maturity. The premium is like a saving of interest expense. The premium cuts the cost of borrowing and reduces interest expense to 8%, which is the market value. The amortization of bond premium decreases interest expense over the life of the bond. In our example, the beginning premium is $4,100. There are 10 semi-annual interest periods during the bond's 5-year life. Therefore, 1/5 years times 6/12 months, or 1/10 of the $4,100, which is $410 of bond premium, is amortized each interest period. Interest expense of $4,090 is the stated interest, $4,500 which is paid in cash, minus the amortization of the premium of $410. The same entry would be made again on December 31st, 2013. So the bond discount balance would be $3,851 minus $385. Worthington Mutual Insurance Company issued a $50,000 5% 10-year bond payable at a price of $108 on January 1st, 2012. Journalize the issuance of the bond payable on January 1st, 2012. We'd have cash debit of $54,000, a discount on bonds payable credit of $4,000, and bonds payable credit of $50,000. Journalize the payment of semi-annual interest and amortization of the bond discount or premium on July 1st, using the straight line method to amortize the bond discount or premium. Interest expense is $1,050. Premium on bonds payable is a debit of $2,000, and cash is a credit of $1,250. Companies may issue bonds payable when they need cash. The interest payment dates rarely are set on December 31st, so interest expense must be accrued at the end of the year. The accrual entry records the interest expense and amortizes any bond discount or premium. Corporations can also issue bonds between interest dates. If they do so, however, they must account for the accrued interest. Companies cannot split interest payments. They pay in either 6-month or annual amounts as stated on the bond certificate. On the next interest date, Smart Touch will pay 6 months interest to whomever owns the bonds at that time, but the company will have interest expense only for the 3 months the bonds have been outstanding. On the next interest date, the company will pay 6 months interest to whomever owns the bonds at that time, but the company will have interest expense only for the 3 months the bonds have been outstanding. Remove the interest payable recorded at the bond's issuance, and record the interest expense for the time the bonds were held, and record the payment. Silk Realty issued $300,000 of 8% 10-year bonds payable at par value on May 1st, 2012, for 4 months after the bond's original issue date of January 1st, 2012. Journalize the issuance of the bonds payable on May 1st. May 1st, cash, debit $308,000. Bonds payable, credit of $300,000, and interest payable, credit of $8,000. Journalize the payment of the first semi-annual interest amount on July 1st, 2012. Interest payable is a debit of $8,000, interest expense debit of $4,000, and cash credit of $12,000.